Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that might sound a little intimidating at first, but I promise, understanding it is one of the most powerful things you can do for your financial future. We're talking about mortgage amortization. What is it? How does it work? And most importantly, how can you use it to your advantage to save a ton of money? By the end of this video, you'll be a pro. Let's get started. So, what in the world is mortgage amortization? Let's break it down. In simple terms, it's the process of paying off your home loan over time through a series of fixed, regular payments. Each and every one of those monthly payments you make is a mix of two things, the principal and the interest. The principal is the actual amount of money you borrow to buy your home. The interest is what the bank charges you for the privilege of borrowing that money. Think of it as the cost of the loan. The magic, and sometimes the frustration, is in how that mix changes over time. Here's the part that catches many people by surprise. At the very beginning of your mortgage, a huge chunk of your monthly payment goes directly to paying off the interest. A much smaller portion actually chips away at your principal balance. Why? Because the interest is calculated on the total amount you still owe. When you first start, that balance is at its highest, so the interest is also at its highest. It can feel like you're just treading water in those early years. But stick with it, because something amazing happens. As you consistently make your payments month after month, your principal balance slowly starts to shrink. And as the principal goes down, the amount of interest you're charged each month also goes down. This means that with every single payment, a slightly larger portion goes toward your principal, and a slightly smaller portion goes to interest. Imagine a seesaw. At the start of your loan, the interest side is weighed down, sitting on the ground, while the principal side is way up in the air. Over the years, that seesaw slowly, almost imperceptibly, begins to tip. The interest side rises, and the principal side lowers. By the time you get to the last few years of your mortgage, the seesaw has completely flipped. Almost your entire payment is going straight to paying off that last bit of principal, and you're paying very little in interest. Watching this process happen is incredibly motivating. So how can you see this in action for your own loan? This is where your amortization schedule comes in. This is your secret weapon, your financial roadmap. An amortization schedule is a detailed table, usually provided by your lender when you get your mortgage. That breaks down every single payment you will make over the entire life of the loan. For a 30-year mortgage, that's 360 payments, all laid out for you. It shows you, line by line, exactly how much of your payment is for principal and how much is for interest, and what your remaining balance will be after each payment. If you don't have it handy, don't worry. You can almost always find your amortization schedule by logging into your online loan portal on your lender's website. If you can't find it there, just call or email your lender and ask for it. Seriously, get this document. Looking at it is a real eye-opener. It transforms the abstract idea of a 30-year loan into a tangible step-by-step plan to owning your home outright. It's the ultimate tool for seeing where your hard-earned money is actually going. Now, let's talk about what influences this schedule. There are three main factors that shape your amortization journey: the loan amount, the interest rate, and the loan term. The loan amount is straightforward. The more you borrow, the more you have to pay back. The interest rate is critical. Even a small difference in the rate can have a massive impact on the total interest you pay over the life of the loan. A higher rate means that interest side of the seesaw stays heavier for longer. The third factor is the loan term, the length of time you have to pay back the loan. Typically, 15 or 30 years. This is a big one. A 30-year mortgage will have lower monthly payments than a 15-year mortgage for the same loan amount. That's why they're so popular. They make home ownership more affordable on a month-to-month basis. But here's the trade-off. With a 30-year loan, you'll be paying interest for a much longer period, which means you will pay significantly, and I mean significantly more, in total interest over the life of the loan compared to a 15-year term. It's a classic case of short-term affordability versus long-term savings. Okay, so you understand how it works, but now for the exciting part. How can you beat the system? How do you speed up the amortization process, pay off your mortgage faster, and save thousands, or even tens of thousands, of dollars in interest? The good news is, you have a lot of power here. The most direct strategy is simply making extra payments toward your principal. Any extra money you pay, on top of your required monthly payment, goes directly to reducing your loan balance. When you do this, make sure you specify that the extra amount should be applied to principal only. This is crucial. Otherwise, the lender might just apply it to a future payment. Even paying an extra $100 a month can have a massive effect. One of the simplest ways to do this is to make one extra mortgage payment per year. You could do this by saving up for it, or by dividing your monthly payment by 12 and adding that small amount to each payment you make. This one simple trick can often shave 4 to 8 years off a 30-year mortgage. Another popular method is switching to bi-weekly payments. Instead of making one monthly payment, you make a half payment every 2 weeks. Since there are 52 weeks in a year, this results in 26 half payments, which is the equivalent of 13 full monthly payments. That's one extra payment a year. Automatically, some lenders offer this as a service, but you can achieve the same result on your own just by following the strategy I mentioned before. Finally, a more significant step is refinancing. If interest rates have dropped since you got your mortgage, you could refinance to a new loan with a lower rate. This will reduce the amount of interest you pay each month. Or, you could refinance from a 30-year loan to a 15-year loan. Your monthly payments will be higher, but you'll be debt-free in half the time and save an incredible amount on interest. This is a bigger decision that comes with its own costs, so you'll want to run the numbers carefully, but it can be a game changer for accelerating your path to financial freedom. So, why does all of this matter? Because your home is likely your biggest asset, and your mortgage is your biggest debt. Understanding amortization isn't just academic. It's about taking control of your financial destiny. It moves you from being a passive participant who just sends a check every month to an active strategist who is purposefully building wealth. It lets you see the true, long-term cost of your home and gives you the tools to reduce that cost. It's the difference between just having a mortgage and owning your home. When you know how your payments are structured, you can plan for the future. You can set goals, like paying off your house before your kids go to college or before you retire. You can make informed decisions about your money, knowing the impact they'll have for years to come. This knowledge is empowering. It turns a source of financial stress into a manageable, conquerable challenge. So my challenge to you today is this. Go find your amortization schedule. Take a really good look at it. Use an online mortgage calculator to see what would happen if you paid an extra $50 or $100 a month. Play with the numbers. See for yourself how much time and money you could save. Knowledge really is power, and when it comes to your mortgage, that power translates directly into real dollars in your pocket. It's your money, and you deserve to keep as much of it as possible. Thanks so much for tuning in today. I hope this cleared things up and made the concept of mortgage amortization feel a lot less complicated. If you found this video helpful, please give it a thumbs up. It really helps the channel. And do you forget to subscribe and hit that notification bell so you do miss out on more tips to help you master your money. See you in the next video.